Okay, so I'm super pleased and honored to open what is a really important event for us. It is important for three reasons. First, it is the culmination of, I think, a year-long effort. And the effort consisted mostly about, Nicolas trying to write a paper which became an essay, which became a book, and longer, and me sort of going after him and saying, why is it not done yet? The second point has to do with substance. So we really believe that the proposal that is here in the book, Breaking the Deadlock, a single supervisor to unshackle Europe's capital markets union, is the single most important single step one can do to push the project further, which happens to be in this sweet spot between potentially very impactful and potentially just about politically feasible. And the whole problem, as you know if you're going to read the book, and as you will hear, is that there is very little else in that intersection. So we think it is a very important thing to think through, and it has to be thought through in all the details, and that's what Nicolas has done. And the third reason why this is very important for us, and I'm very happy, is that Stefan Ingves is joining today, and of course he is an incredible authority, someone who I have looked up to for a long time, someone who I've overlapped with at the International Monetary Fund, and we are just terribly sorry that he's not here in person. The reason is that his flight was cancelled for reasons we don't completely know, but we suspect have something to do with the drone issue and the closing of Brussels airports for 5 hours last night. And that's all I need to say, and I now hand over to Rebecca Christie, who I'm delighted agreed to chair this panel.
Thank you very much, Chairman Zettelmeyer, our director. We are so glad those of you in person could join us and those of you online, including Stefan, for the official presentation of this really big deal book. Those of you who are part of the zeitgeist know that the European Commission is preparing some sort of proposal on how to improve capital market supervision. You might have heard Carlo Camporti from Consub yesterday speaking about the need for national supervisors to work more closely and more aligned and possibly even push some of their duties to the European level where it makes sense. And Nicolas is going to walk us through what the end state could look like and why it's so important to get there. So with that, Nicolas Véron, please tell us about your book.
Thank you so much. Thanks, Rebecca. Thanks, Jeremy. Thanks, Stefan. And again, sorry for the logistical disruption. Nothing we could do about that. Indeed, this is timely. The essay itself was published online by Bruegel in late June. We now have printed copies. If you don't have one, there are still some outside. And what I will do is basically summarize the argument of the book. I have a few slides. I don't know if they can be put on screen. Probably they will be. Yes. Actually, I can move them, probably. Yes. So this is what I will talk about. The recommendation is something that could be labeled a supercharged ESMA. Jeremy already introduced a little bit the spirit of this recommendation and mentioned that it took me a long time to get the piece out. Actually, it's one of those few relatively rare cases of a research project where you end up in a different place from where you started. Initially, I will come back to this, I had a less radical view of how to reorganize capital market supervision in the EU. I thought it could be done essentially along the lines of what was done for banking prudential supervision with a single supervisory mechanism more than a decade ago, the SSM. And then for reasons I will now explain, I realized this wouldn't work for capital markets, and therefore this proposal is a bit more goes a bit further in terms of EU-level integration. So I will make the argument that capital markets supervision matter, that as Jeremy suggested, in terms of EU-level legislation for capital markets union, there are other ways reform can happen, but in terms of EU legislation, this is the only game in town. As I just said, the arrangement has to be different from either the current ESMA or the SSM, and I'll conclude on how to make it and feasibility. So very quickly, the proposal is a supercharged ESMA. ESMA becomes what Christine Lagarde in November 2023 memorably called the European SEC. You remember that speech about a Kantian moment or Kantian leap for EU capital market supervision. And the idea is indeed a single supervisor, which is something that has been aspirationally talked about for about 20, 25 years, but I argue here is the moment to make into reality. So ESMA would be profoundly transformed. It's not your current ESMA, it would be a different ESMA. It would consolidate all the capital market supervisory mandates. I counted several dozen of them. They're in Annex A of the book. There would be a long transition. It would take a decade, but if you think about it, if we had started that when Juncker started talking about capital markets union in 2014, we would already be past completion. So a decade is long, but not that long. And at the end of that transition period, the existing authorities, some of them are standalone authorities, so securities commissions like exist. You mentioned Consub in Italy. Actually, they're all in the southern fringe. So it's Portugal, Spain, Italy, France, Slovenia, Greece, and Cyprus. In most member states, in all the other member states, we're talking about not closing down an authority as such, but reducing their scope by closing down basically the capital markets department. But if you think of BaFin in Germany, for example, or the integrated supervisors in Nordic countries, they would keep the rest of their business, which is mostly prudential. I also suggest including within the scope the auditor supervision, which is a very niche and nerdy area. In most member states, there is a standalone audit supervisor, so these would also be phased out at the end of the transition, because I think the supercharged ESMA, expanded ESMA should also be in charge of audit supervision. It's a bit of a side issue, but if you take that together, it would be a very significant simplification of the landscape, because altogether you would end up with, when you take all the national financial supervisory authorities, all considered, including AML, insurance, pensions, what have you, the number of those national authorities outside of central banks in the EU would be reduced by more than half if you go to the full way of this proposal. So ESMA would be much larger than it currently is. As I said, it's a different ESMA. It would have probably something like, several thousand staff, distributed geographical footprint with national offices in probably each of the member states. Most of the staff would be outside of France, where ESMA is headquartered. It would stay headquartered in France, of course. There would be lead teams for at least some supervisory mandates located in the national offices. So you could imagine, I mentioned auditor supervision, for example, the leader of auditor supervision and their team would be, for example, I don't know, in Amsterdam or Luxembourg or Bratislava, what have you. This would respond to a very important political and substantial requirement of this reform, which is what I called in the essay location neutrality. Basically, that the setup should not favor, and maybe even more importantly, should not be viewed as favoring one financial center over the others. And I think this is one of the most important political conditions for this reform to happen. ESMA would still be in Paris. Their footprint in Paris would be bigger than now. There would be, I don't know, think 1,000 staff instead of 300 now. So France should also be happy with that. Even so, it would not be a Paris-only organization. The good thing with this proposal is it's very simple. It aligns the incentives for European integration and high-quality supervision everywhere in Europe. It would also, but I won't expand further on this, give Europe international heft. At this point, it's important because ESMA would become really a very big beast in the international landscape of capital market supervisors. Okay, so why is this important? Very briefly, capital markets are heavily regulated, so they're shaped by their supervisory structures. National supervision creates incentives for national market fragmentation within the single market. So in terms of capital markets integration, there is an obvious advantage in supervisory integration, and indeed supervisory convergence, which is this idea that you have a central body that will incentivize or nudge national authorities to take similar approaches in similar cases. This has been done for now more than 20 years, since the beginning of the Lamfalussy process. For the old-timers, it has not worked. So there is really a need to move on to the next step. And similarly, it's a passporting thing. If you look, for example, at asset managers, it works in theory and not in practice. National authorities always find ways to create requirements for national entities. So maybe less intuitive point is that it's not just about market integration, it's also about capital markets development, because with the current setup where you have very heterogeneous national supervisory authorities, essentially the system is as good as the weakest link. And if you look at Wirecard, it shows that even in the biggest market out there, Germany at the center of the EU, you have such poor supervisory performance that it basically drags down the entire asset class. In a way, it's not surprising that Europeans don't invest in European equities when you see a story like this one, which would not have happened in the US. I know there was Enron and WorldCom and things, but nothing as basic in terms of comprehensive supervisory failure as what we saw with Wirecard, both in terms of auditor supervision, but also accounting enforcement by BaFin, and of course also the licenses for payment services and banking. So the point here is that we have proofs of concept which demonstrate that if we move that responsibility to the EU, and I think the SSM here is a very good example, it will be better than not just the worst case national practice, but also the average or even some of the best national practices. And therefore, you will get a better supervisory performance with supervisory integration. So a catalyst for market integration, of course, but also market development. Now, very quickly, why is it the only game in town? Because basically the other games are not really there in terms of EU legislation. Of course, you can have a lot of national reform. As Jeremy mentioned in a previous discussion about this, for example, the German pension reform, if it happens, can be very transformative and catalytic, not just for Germany and the European capital market, but also for reform in other EU member states. So this is not to say this is the only way to do reforms that goes in the direction of capital markets union, but it's basically the only way to do it in a transformational manner with EU legislation. So if you think of EU legislation, this is the only game in town. The other ideas, insolvency law, we have a lot of debates at Bruegel on the 28th regime. Some of my colleagues will probably publish a very important paper on this soon. I have to confess I'm a bit of a skeptic on the possibility of achieving something big with that, but this is up for debate. Similarly, in terms of fiscal union, safe asset, we can discuss it. It's unlikely that this will come out of the capital markets union agenda. So maybe fiscal union will happen in this term, who knows, but if it happens, it will not be triggered by this kind of concern. So essentially, here's a narrative, is just to say you don't beat something with nothing, and this is something. It doesn't solve all problems, but it is a big step forward and would be recognized as such, also, by the way, by global investors who are hesitating to locate their assets in the EU and Eurozone. Then, as I said, when I started this, I thought the SSM model would be a good model for organizing a supercharged ESMA. So you would have a central body, you would have national competent authorities, and you would have a kind of way to make them work together with joint supervisory teams or things like that. And this indeed is the proposals in both the Letta and the Draghi reports. They recommend an SSM-like design. But then when I worked more on it and looked into the details and the practice, the more I did that, the more I realized capital markets are different. So first, ESMA is not the right design as it currently exists. It was not designed by the de la Rosière group to be a supervisor. It was designed to enhance supervisory convergence, but as I said, this hasn't worked. The governance doesn't work for supervisory effectiveness. I should mention again, it was in an earlier slide, that I'm an independent non-executive director of an entity which is supervised by ESMA, but emphatically I'm not speaking in this capacity today, so I have an internal Chinese wall in this respect, so don't, this is not about the organization I'm a board member of. And you can see it in recent legislative contortion. So if you think of clearinghouse, legislation had to create a completely parallel structure for clearinghouse supervision within ESMA, which is incredibly Byzantine. If you think of crypto assets, they have not been given to ESMA because there is not the trust that ESMA will supervise them well in some member states. And the same in securitization. So you can see ESMA not getting the mandates that they should get in terms of EU-level supervision because basically the legislators don't trust ESMA to do the job very well. That's not what they say, of course, but that's the revealed behavior and preference. None of this is about the personnel at ESMA, which are first grade. Let me be very clear. This is not intended in any way as a, an underestimation of the performance of the leadership and staff of ESMA. Absolutely not. It's really about the governance. It's about the enabling legislation. Basically, the point I'm making is that given the legislation, the legislative framework for ESMA, there is no way ESMA can be a good supervisor, despite the best efforts of their leadership and staff. But the SSM design is also not right. The reason for that is that capital markets cluster in a much more powerful way than banking. So basically, in every member state, you have banks, you have smaller banks, you have larger banks, and you have a job for the national banking prudential supervisor. It's different in capital markets. If you look at all these market segments, in most of them, the activity is just in a handful of member states. And therefore, most of the authorities don't know and don't care about that segment. And therefore, if you have a governance framework and an organizational concept which is based on the NCAs like the SSM is, it will be dysfunctional by design, as the current ESMA framework currently arguably is. Additionally, the notion that you should have the small entities dealt with at the national level, the larger entities dealt with at the European level also doesn't work in capital markets because capital markets, a bit like AML, we can discuss if we have time how this challenge has been dealt with the design of AMLA, the AML authority, which is starting business in Frankfurt. It's conduct of business supervision. So that means it's typically your needle in the haystack. It's not a matter of proportionality where what you have in prudential supervision where basically big entities matter more than small entities. In conduct of business, it doesn't work like that. You can have a small entity that really creates a lot of trouble for the market as a whole, and therefore the notions of proportionality and subsidiarity that are enshrined in the design of the SSM with this crucial divide between significant institutions, SIs, and less significant institutions, LSIs, it doesn't work for capital market supervision. I know that the Commission is currently trying to make it work on a number of market segments. Basically, what I'm saying is it won't work the way it does quite well, actually, in prudential supervision. And this is because we're talking about conduct of business. Also, a less important factor is that one saving grace of the SSM design is that not all, but most NCAs, most national competent authorities in banking prudential supervision are very independent from political power because they're enshrined in national central banks, and that's protected by Maastricht. This is the case for some member states, half a dozen member states. In capital market supervision, if you think of Ireland, Slovakia, I think 2 of the Baltic countries, they have these, the central bank empowered for capital market supervision, but it's a minority of member states. And therefore, you don't have the same element of independence in the network of NCAs. And finally, I think now, 10 years after the beginning of the SSM, even so I'm very supportive, as you know, of the SSM. I think it works. It should not be changed. But there is more of a realization that this complexity of having the NCAs together with the ECB generates friction, generates cost for the industry, generates sometimes a little bit of dysfunction. And I think that experience also should go in the direction of looking for a simpler design for capital market supervision. Okay, let me move towards conclusion. So how to do it? You start with the political decision, which has to be by the heads of state and governments. If you leave it to the finance ministers, it will be the same deadlock as usual. So it has to be with the highest level of political energy, and that can be done pretty quickly. In the essay, which was published in June, I said it can be done before the end of 2025. I think I will be a little bit more realistic now and say within 6-9 months from now, so in the first half of 26. But it really can be done. I mean, you really need just to have a go decision by the leaders, by qualified majority, by the way, assembled in a room. So it can be one line item in a European Council meeting. And this is not, there is no deal breakers that would prevent them from making the decision or, call for more technical expertise. This is very complex when you look at the implementation, but the principle of it, there are no counter-arguments that would make this impossible or call for, more waiting, playing for time. So what the leaders should say is just very simple. We want to do this. We want a single supervisor, as Mrs. Lagarde said 2.5 years ago, and we want it to be up and running in 10 years' time. Why 10 years? Because you need a lot of legislative work. You need a new legislation for ESMA that can be done in the current term, in that calendar, with a new governance, a new funding concept, the authority to open the national offices. But then you need a lot of legislation, mandate by mandate, market segment by market segment. As I said, there are several dozen of them. It's very different from banking supervision here. You really have all these different things, myriads of different players and market categories, and you need different legislation for each of them. So that would take a full term, and then you add a year or two for implementation, so you're already in 2035. Can it be done? Well, obviously, there are multiple points of inertia. The private sector, the supervised entities, always have a preference for the status quo. Don't count on them to advocate reform. Very few of them do. Some of them, but very few. So national authorities, as we know, they're not super enthusiastic about the idea of being replaced by a European authority. That's normal. I think what is more specific to the issue is the concerns I mentioned about location neutrality, which really need addressing. This is why we need ESMA to have national officers and have a culture that brings together the experiences of the different member states and not just France. The concerns about the quality of ESMA supervision are real, especially in countries, smaller countries like Luxembourg, Ireland, Belgium, to the extent it is concerned with some big infrastructures, Cyprus, Malta, the Netherlands. That's basically the list. But for those countries, the capital markets really are important in the national growth model, in the national business model. And they legitimately need to be reassured that the quality of supervision will be as good as what they have now. And if ESMA cannot provide it under its current design, which I believe is sadly the case for the reasons I have mentioned, they need to be reassured that it will be a different ESMA that can do a better job. And finally, there is, the inevitable economic nationalism. In some countries, the national stock exchange is a big symbol, but this is not insuperable. If you look at what Greece just announced, you can see how countries can shift from a very nationalistic position to a much more open position when they just look at what's in there for their SMEs. Because in the end, that's what is important, right? We want capital allocation to go to the companies, the high-growth companies that need it. So this is a matter of really putting the interests of high-growth companies first before the interest of the entrenched incumbents in the financial intermediation landscape. A number of political leaders get it. If you look at what has been said in Germany recently by both Friedrich Merz and Lars Klingbeil, if you look at what I just mentioned about Greece, which is really a very important and powerful statement in favor of EU integration, if you look at what's happening in a number of other member states, there is a critical mass of political leaders out there who understand the urgencies, they understand the need, of course, for strategic autonomy. I don't need to expand on that. They understand the point about simplicity and the fact that we need to get beyond very intricate compromise that generate more processes, more coordination, deadlines, etc. The great advantage of this design and the reason why I keep thinking, despite the obvious political obstacles, that it may be adopted is that it's very simple and it basically solves the problem. Thank you very much for your attention. I look forward to Stefan's critique.
Thank you for that. Everyone, you can get the book, you can get a PDF of it anytime off our website. If you do nothing else, I encourage you to flip through to the table that shows all of the different competences in all of the member states. It will probably be the first time you've seen them all in one place. And it's really striking, and it makes it easy to see both the regulatory arbitrage and just complicatedness of the current situation, and also ways you could rearrange some of those columns and make things better. It's a real visualization. Stefan, you have been working in this sector for so long in so many different ways. We are so delighted you are here to speak to us about the situation and about Nicolas' proposal. Tell us what you think.
Well, first of all, thank you for giving me the opportunity to say a few words on this topic. Nicolas and I actually had a fascinating conversation about these things in the early stages of this project. So I'm glad to see that it has been concluded. Unfortunately, drones or no drones, very early this morning, 2 different routes to Brussels were blocked. So eventually I had to give it up completely and have to do it this way instead. I have put together a short presentation where I'm going to comment on what we have heard. And this presentation is, of course, very much based on my own background in this field. So let's see if I can make this work. So a truly European ESMA, that's really what we're talking about here, and that is kind of as a subsection or a sub-part of what goes under the heading of Capital Markets Union, or sometimes it's also called nowadays a Savings and Investment Union. And I'll sort of briefly comment on CMU and SIU and why this is a problem in itself when it comes to how you actually describe these things. First of all, Nicolas' report then, breaking the deadlock. I mean, I agree with Nicolas' conclusions. And the bottom line is very, very simple when it comes to this, because in this day and age, when nothing is on paper, everything is digital, you really don't know where assets and liabilities and money is located anymore. And in that environment, it's not good for Europe, and it's not good for individual countries to have a system which on the one hand is completely decentralized, while on the other hand, there aren't really any impediments anymore to moving things around. So clearly, at least in my view of the world, this is an unstable, undesirable equilibrium presently, and it's kind of not moving, is kind of trying to move with your back into the future, arguing that things used to be better in the old days, which is actually not the case, given the technological evolution that we're going through presently. And that means that in that environment, I'm strongly in favor of creating an ESMA with teeth, and it should be done sooner rather than later. I have also been led to believe, coming from I call my own country a small country. Some people in this country wouldn't like me saying that, but I have concluded, having been in this business now for a long time, that it's incredibly hard for many, many economies that you find within the EU to actually establish very good supervision within this field, because there are so many things going on, and over time you just cannot create the brain power that you need in order to do this. And that means that for Europe to speak on behalf of Europe as a whole in the world, you actually need to centralize more than what we have done in the past, because otherwise we will make mistakes. There will be regulatory arbitrage, and our voices won't be heard in the global discussion about what goes on here. Now, Nicolas also talks about national framework conditions, and here we're basically thinking about as an obstacle, tax systems, bankruptcy procedures, and many other things. But yes, they are an obstacle, but they are only part of the problem. And I think that Nicolas rightly so says in the report that to think that you would be able to remove all the national framework conditions in the short run is impossible, and probably also so in the long run, because countries come to different conclusions, for example, when it comes to pension systems and many other things, and those are in some sense national value judgment. At the same time, which is fascinating when it comes to the report as such, and I'm a nerd when it comes to these things, is that the report has eight pages of references. And that's remarkable in itself, just to finding this number of various documents talking about this issue for not only 10 years, but 20 or 25 years or something like that. But at the same time, let's admit that if we've been talking about this issue in Europe for 10 plus years, and we have 8 pages of references and almost nothing has happened, that's a failure. And we really, for the good of Europe, need to move from words to deeds, and that's why I think that this is a good report. Hopefully, pushing the issue. Having said this, what is it that makes this so hard to do? First of all, I have commented on the Capital Markets Union / Savings and Investment Union over the years when I was central bank governor in various, particularly informal ECOFIN meetings. And immediately when I started talking, you could see people's eyes glaze over, particularly on the political side, because CMU, SIU is such an abstraction that if you come from the political side, with a fairly high likelihood, you have no idea what this is all about and why it would be a good thing. And you just don't understand much of the plumbing that you need to have in place in order to make these things happen. So on the one hand, many on the political side tended to be in favor. But when you got into the weeds and started talking about the details, then being in favor very often turned into being against, because then the short-sighted national interest got in the way of what needed to be done. So if you start from above, then it is difficult because CMU, SIU is an abstraction, and you need to break down that into something which is actually doable step by step. At the same time, when it comes to creating markets and when it comes to creating new markets are basically built from the bottom up. And that means that you have to have the plumbing in place, and then you have to have borrowers and lenders, you have to have savers and investors, and you have to have supply and demand of these financial assets in different shapes and forms. And this over the years has also created additional problems, because some people talk about the Capital Markets Union, as I prefer to call it, in terms of, let's say, risk capital that is supposed to go to small and medium-sized enterprises. And that's one end of the spectrum, risk capital. And then at the other end of the spectrum, you have the conversation about the risk-free euro-denominated bond. And in order to create actually a successful capital markets union over time, you are going to need both SME risk capital and a risk-free pan-European asset in one form or the other. When it comes to the latter, but that's a different seminar, we need a European debt agency. But that's a completely different conversation for today. And then, of course, what always happens when we talk about these issues, then you tend to have a bunch of bankers somewhere in the middle arguing that if you lower the capital charges on banks, everybody will be happy forever. And believe me, I don't believe in that at all. And in addition, this is something which is much more complex. And this is actually something that ideally should happen outside the banking sector, so that we create more markets than fewer markets. And we do know in Europe that an issue in itself is a system which I would argue is way too bank-centric. Now, I'm talking about what I call pan-European plumbing. And as far as I can see, very, very few authors, individuals talk about a pan-European plumbing. And I do think that as an addition to what Nicolas has talked about when it comes to designing a new ESMA, this is really, really a new role for ESMA to keep an eye on in order to ensure that we have something which is over time truly, truly pan-European. That this is a dilemma, it's obvious if you look at the appendices in the report, because there it says that we have 33 securities depositories in Europe. We have 26 regulated markets / exchanges, and we have 14 CCPs. I do not think that that is something will last over time, because we really do need, when we're talking about IT systems, because essentially we're talking about IT systems. If we add up 33 plus 26 plus 14, then there's a need to encourage consolidation. And I do think that that consolidation should happen, ought to happen, and actually de facto over time, ideally, will happen. And then we really, really need to make sure that we have interoperability cross-border. And if that is not the case, then it's the job of ESMA to show where we are and kind of point out to jurisdictions where we need to move. And here is just one simple example how to do this, because it's not hard. It's a lot of work, but it's not hard. And it could be easily run by ESMA to write kind of an annual report where you, on the one axis, have jurisdictions, all the EU members, you keep track of who they are, and on the other axis you have the plumbing tasks, as I call them, and then you have colors, whether you are red, you have done nothing, you are yellow, on your way, or you have already fixed this problem. I have not been able to find anything like this when I have prepared for this seminar, and I have glanced through between 40 and 50 different pages and newspaper articles, but nothing of this exists, and that would be a small step forward in order to actually understand what the map looks like and how the map ought to change over time. Now, here, of course, one recurring issue, which is not specific for the ESMA issues, is really the political perspective. And the political perspective within Europe very often is such that you start out thinking about what is good for my country in Europe. And that's very often, by the way, and many people probably don't like what I'm going to say, a Swedish perspective, since my view is that we're only half a member of the EU. But again, that's a different seminar. So really, you need to change the perspective and think about this in terms of what is good for Europe in the world, and that is actually good for my country. That's how you need to think about these things, and that's why you should support this movement when it comes to building these markets, which probably will take decades, but that doesn't mean that one should give up. So all in all, I've seen this happen before in my country and in different parts of the world. And believe me, it's hard work, but it's not rocket science. And really, really, to make this, why this has not happened in the past is because there has been a true lack of leadership. And now, as also Nicolas pointed out, we need more leadership at the top in order to make these things move, because otherwise people will just kick the can down the road, and that means that Europe as a whole will come out as a loser vis-a-vis the rest of the world. Thank you.
Thank you so much. Thank you so much for that. Those of you interested in the bank capital debate should look to the paper that Nicolas wrote with our colleague Juan Mejino Lopez. You can find that on our website. We will not get into that at this time because we've got about 20 minutes left for questions. While you think of your questions, Nicolas, to just take one thing that Stefan said at the end, this would not need to happen at the euro area level first and then at the rest in the way that banking supervision did. Is that right?
Yes, this is a single market issue. There is no specific identity of the Eurozone in terms of capital markets. Of course, the ECB is a central bank of issue when it comes to some specific aspects of clearinghouse, central counterparty supervision, but not different from the bank of the Riksbank in Sweden or the National Bank of Poland, or you name it, in the other member states, which are also central bank of issues for the respective CCP. So this is a single market issue. It actually does include, Norway, Liechtenstein, and Iceland, and it's for the entire EU.
Thank you. Do we have questions in the audience here in the room? Yes, back here, and then Zsolt. Please introduce yourselves. Thank you.
Thank you so much. Yes, this works. Linda van Goor, I'm a harmonist trying to find the balance that does justice to all. Thank you so much, Nicolas, because this also complements a report that you published before the summer about the competitiveness of banking for the European Parliament, in which, with others, in which you also noted that it's the complexity that makes the costs and that affects the competitiveness. It's the patchwork of member states' rules, and it is complexity of group structures, all fiscally driven, so all member state driven, so to say, and not the level of the capital requirements. I was very happy with that report, and I'm happy with this. Scanning through it, you make me dream, because like figure 1 on page 15 mentions macroprudential banking supervision. We could do that the Brazilian way, like at parent level, accountability, transparency, and well, we could dream along, but the million-dollar question is really, and I have that to Mr. Ingves, how do we get the member states, how do we seduce the member states to cooperate here, to trust each other, and to go for this thing that would obviously be good for industry? We don't need more evidence. 8 pages of references, we have enough evidence. So it's not about the arguments.
Yeah. Do you have another question, or is that the question?
That's the question. Like, how do we get the member states to trust each other?
We will come back to that. We also have a question here from Zsolt Darvas from Bruegel.
Thank you very much, Zsolt Darvas from Bruegel. So excellent proposal. I 100% agree. I have 2 questions. The first is, you rightly say this is a single market argument, possibly including non-EU countries. But my question also related to the previous one. If some countries don't want to participate, is there a scope for a smaller group of countries, both within and outside the EU, to start it? And then maybe others join later if they want. If they don't, they won't. And the second question is more on the substance. I'm not an expert of this topic. So you started to motivate your proposal by saying that the national supervision cements local capital markets. Now, if I look at the banking union experience, I think what is really clear that the quality of supervision probably increased. But I wonder whether centralizing supervision in the banking union has increased to more cross-border banking within the euro area. You are the expert, so you would tell me. But in light of that, how do you think that a centralized supervision for capital markets will indeed create much more cross-border activities? Thank you.
Thank you so much. So I'll take the questions in the order they were asked. How to get the member states in? I mentioned the fact that a number of national leaders, and in the case of Germany, coalition leaders, have hinted at ambition. Now, I'm fully aware of the domestic obstacles in the respective countries, including in Germany, when you think of incumbent financial groups. Germany is special because it's the only country where subnational authorities are stock market supervisors. So the different lenders are supervisors of the respective stock exchanges. It's not hugely important, but it complicates the matter and it creates difficulties for the coalition. So all these things are complicated. But I think I'm not going to go country by country, but I would say a critical mass of European leaders get it in the sense that they understand, as I said at the end, that this is about high growth firms. This is about creating an environment where promising companies can list in Europe, build their dream, sorry for the allusion, in Europe, and not go to the US at some point of their development. And this is more important than protecting this or that piece of financial infrastructure that sponsors a local music festival or something like that. And this is really the key choice. Do you want to work for the economy, for the companies of tomorrow which need a good capital markets, also for the investors and savers who need the returns, or do you want to work for a narrow clique of incumbents that benefit from the current fragmentation? This is a political choice. And I think a number of leaders understand it increasingly as such. And the more leaders understand that choice, and this is precisely why it cannot be a decision for finance ministers, because finance ministers are paid to cater for the constituency of financial intermediaries. That's their job, partly. I mean, I'm a bit cynical, but you understand the point. Heads of state and government are different. They have to balance the different interests in a way that I think creates a space for this decision to be made. Now, do I put a probability on it? No, I don't put a probability on it. I say there is a space for that decision to be made in the next 6 to 9 months. It's possible. There is no impossibility. It doesn't require fiscal risk sharing. It's much less difficult than completing the banking union. I'll come back to this in response to Jolt. And therefore, it is difficult but feasible. To Jolt's questions. The first one about opt-in or variable geometry or differentiated speed. This is really a core single market issue. So I find it very difficult to imagine that you could make exemptions, because the exemptions would immediately generate opportunities for supervisory arbitrage in a way that would kind of defeat the purpose. What I think is more possible is maybe as an element of the political horse trading to exempt some market segments or to delay the supervisory integration for some market segments, if that can facilitate clinching a deal. And here I'm thinking specifically of financial infrastructure. I agree with Stefan that it would be nice to have ESMA authorities as soon as possible on all the elements of the infrastructure, so stock exchanges, central counterparties, central securities depositories, also trade repositories and other things like that. But in a way, this is kind of overemphasized, particularly in the Draghi report, because at the end of the day, it's not the most important thing. The most important thing is securities market enforcement, particularly financial disclosure enforcement, making sure that equities and securities throughout Europe provide the right information to investors. And this is the core of this conversation. If the infrastructure thing, because of the strength of some entrenched interests, has to be delayed a bit, I would personally view that as a space for some compromise. I know this is the exact opposite way of how it's often presented in the debate, but I think part of that is because many of the people involved in the debate, and Draghi is no exception, are central bankers, and naturally central bankers tend to focus on financial infrastructure more than on market integrity. That's normal given their background and culture. But I think the market integrity piece, the market the quality of information of financial disclosures, and by the way, non-financial disclosures as well, is really at the center of what we're talking about here. And that's core single market. It should be all of the EU. By the way, this is qualified majority voting, so no country has a veto. And therefore, it's not the same level of difficulty than what has been achieved with the SSM regulation, which was unanimity. Final question, speaking of the SSM, the difference with banking union. Banking union, as you know, is a halfway house. I wrote another Bruegel book on that last year with European support. And banking union is unfinished because the supervisory piece is done, but what is not done is the safety net piece. How do you deal with banking crisis? How do you do bank resolutions? That includes deposit insurance. It has a read across in terms of the regulatory treatment of sovereign exposures. I'm not going into that, just to say that in banking union, Europe did supervisory integration in the Eurozone, but did not do the integration of the safety net that is indispensable for banking. In capital markets, the good news is there is no such safety net. There is more market discipline, there is no bailout. We can discuss CCPs, it's a bit of an outlier, but even for CCPs, you don't have the same element of quasi-fiscal safety net that you need for banking, and that's explained in the essay. So in a way, you get more bang for your supervisory integration buck, because with supervisory integration, you basically complete the project of this capital markets union from the perspective of the financial services legislative apparatus in a way that hasn't been achieved in banking union, because you still have this crisis management and resolution element, which remains essentially at the national level at this point. So essentially the point here is to say it's easier than in banking union, and supervisory integration gives you the full job. Now, even for banking union, and let me finish on that, I think there is more that is achieved than generally gets credit for. We will see what happens with UniCredit and Commerzbank. Let's remember that this deal is not dead. Mr. Orcel is patient. I must mention at this point that UniCredit is a member of Bruegel, but this doesn't color the way I speak about it. And this deal may happen, and if it does happen, it will transform the landscape. There have been many cross-border deals that are kind of under the radar, but if you look at Hellenic Bank in Cyprus, Alpha Bank in Greece, Novo Banco in Portugal, and a number of others, there have been a bunch of national champions that have been consolidated across borders. For Alpha Bank, it's ongoing, but it will probably happen. So the takeaway from banking union is that you're generally right, Jolt. There have been not enough market integration to consider the job done, but I also wouldn't say there has been nothing.
Nicolas, quick follow. Is there a banking union model where smaller enterprises, and you talked about this in your slides, but could there be sort of a grab if there's problems issue, or does the conduct of business quality rule that out?
I understand that's what the Commission is trying to do, and I wish them well, to try to define a threshold in the different market segments, with ESMA doing the bigger ones, national competent authorities doing the smaller ones. I don't think it works very well, and I want to mention something else, which is that if you go in that direction, you will have increasingly parochial, increasingly behind the curve national competent authorities. Stefan alluded to that in his remarks at the beginning when he said, it's very difficult to gather the critical mass of skills, expertise, experience, and understanding in a national competent authorities for these very complex markets. So essentially, what I'm saying here is, in theory, you can always say, yeah, I take the big ones, the small ones stay at the national level.
But the question was, the ECB can go in and take a small bank if it feels, so could you have that?
You can do what you want in the legislation. Again, it's a national, it's a qualified majority voting. The legislators can do it the way they want. But I think this won't work the way it does for the SSM. I think the SSM works quite beautifully. It's not perfect, of course. There are many complaints about bureaucratism and so on. The SSM is working on it. But it works quite beautifully in terms of alignment of incentives. I don't think you can achieve the same alignment of incentives with an SSM-like design for capital markets.
Thank you. We'll do 2 questions here in the room, then we'll go to Stefan, and then give it back to Nicolas. And unfortunately, that'll probably run up our time. So thanks. And questioners, try and be direct, please.
Thank you, Nicolas. Thank you. Alex Beriter with AGI, Johns Hopkins. My question goes to, so your proposal is clearly much more ambitious than all the stuff that we heard from the Commission and around the Commission about sort of about introducing or changing the nature of ESMA. So my question is, given the likelihood of substantial political roadblocks, if we assume that those roadblocks could be overcome, why do you dismiss in your presentation the role of the 28th regime to a certain degree, and what Stefan Ingves was talking about, which is the introduction of a risk-free asset, which we currently don't have, even if you add up all the NGU bonds that are out there, coupled with other supranational bonds. Clearly, from the investor's point of view, they don't represent a permanent safe asset, but just a partial and temporary one. Thank you.
And then Jose, behind you.
Oh, sorry.
No, thank you. I have 2 questions. So the way you
Jose, please introduce yourself. Thank you.
Yeah, sorry. José González Mínguez with Banco de España at the House of the Euro. I have two questions. So somehow you put this as the big transformational step that can be done, centralized supervision, since we must give up hope in more regulatory convergence. My question is whether it is feasible, actually, to put in place this centralized supervision without any further regulatory convergence. We know that there are, the issue of gold plating and many national specificities that this centralized supervision would have to face, and the question is whether it would be well placed to cope with this problem. The second issue concerns what you named this diversified geographical footprint. No, this fact that you postulate that the ESMA should have these sites in the national capitals. So you argued that the main reason to do so, or perhaps the single reason to do so, is political concerns, political feasibility. So this sounded to me like a second best, which probably is. So somehow you have some guesstimate, if you want, of what the efficiency loss is because of going through this second best solution. Thank you.
Thank you very much for that. Because of the short time, Stefan, I'm going to ask you to pick and choose from what was said before and the questions we just got. Answer the ones you think are most important or that have not already been covered. And then after you wrap up, we'll give it to Nicolas.
Yeah, just let me repeat what already has been said, and that is that there is a need for standardization. Because if there's not enough standardization, you don't know what you're buying, and then you don't buy things basically cross-border. So that's an issue. On the whole issue of what I call the plumbing, keep in mind that it's going to be, and it already is, increasingly difficult to define, if you actually look at the details, define the geographical location of a stock exchange. And look at the Nordic and the Baltic countries where NASDAQ is everywhere. And what does it mean to have a local stock exchange? Not much. And basically, it's all about the IT systems at the end of the day. And over time, it will become more or less highly uneconomical to try to build your own IT system when it comes to, for example, running a stock exchange. So there are huge returns to scale to actually centralize a lot more cross-border than what we have done so far. And that certainly can be done, and it's not difficult to do.
Very quickly, for lack of time, on the questions that were asked. Well, Alex, you said my proposals were radical. In a way, they're not more radical than what Lagarde said in 23 and 24 when she said a European SEC, and in 24, importantly, she also endorsed this idea of national offices for ESMA. So I'm not outside of the zeitgeist in the way I look at it. I think, again, there are very sound reasons, and let me go back to the last question that was asked, to advocate this multicentric distributed model. It's not for political compromise, Jose. It's the first best, in my view, in terms of an organizational concept that would be suited for the task at hand. There would be no duplication of jobs. You have people in the member states who are at the contact of local stakeholders, and you will keep having local stakeholders in the different member states. You need to speak the language, understand the context, and this is better done from Ljubljana than from Paris if you're dealing with Slovenian stakeholders. And therefore, the notion that you could have a single ESMA all in Paris with, a big tower in Paris dealing with all the issues in capital markets throughout Europe is just not realistic. So this is the simplest way to organize it, with one organization in charge instead of 28, 27 plus one. It's not a political compromise. It's on substance the best way to go. Back to Alex, 28th regime, safe assets, 28th regime at this point is not about capital market supervision. You can think of 28th regime for capital market supervision. There was a little bit of that in the Noyer report. Basically, it doesn't fly. So the 28th regime is a separate discussion. It's not about what we're talking about here. It's about the things that I call framework conditions, or things that deal with national social models, pension, insolvency law, taxation. We'll see how it goes. Maybe it can be done, like the Spaniards have said, on a bottom-up basis. You start with 3 or 4 member states, but again, you have issues of single market fragmentations that quickly pop up. Essentially, when I say I'm not sure there will be some things there, I wish there will be, and I support my colleagues who work on that, but it's on a different space policy-wise, so these are not contradictory. Similarly, for safe assets, I'm only in favor of safe assets. I'm in favor of fiscal union. I happen to believe you need to change the treaty for that, but maybe I'm wrong. But it's complementary. I just think if you're the commissioner in charge of financial services, you should put all your energy on this thing and not on alternative things that are basically not in your hands. Regulatory convergence, is it a precondition? No, it's not. We already have a lot of harmonization that has been achieved in the space of capital markets. So at this point, you have a body of applicable law which is partly harmonized, partly unharmonized. A bit like what we have in banking supervision. You know that very well. You know that, for example, the fit and proper test for banking managers, which is now administered by the ECB for significant institutions, it's not harmonized at all. So it's a nightmare for the ECB. They hate it. They have to face national courts and national legislation. It's very difficult to do, but they do it, and they do it well. So similarly here, you would, of course, need to have further regulatory convergence or regulatory harmonization. I explained that in the essay. But at this point, the lack of supervisory harmonization is the biggest bottleneck in terms of regulatory harmonization. So if you create a single supervisor, you open a gigantic space for further regulatory harmonization, moving from directives to regulations and what have you. And if you remember my slide about the sequence, you have 5 years to do that. So first you create ESMA in a capable European supervisor in the supercharged ESMA. But then you spend 5 years doing exactly what you're talking about. Given that you open that space, you harmonize the legislation market segment by market segment. There is a lot of legwork to be done there. Every market segment is a little bit different, but you can go much further if you have that supervisory overlay that has been decided by the political principles. So I think that is obviously the right way to go. I think we have gone basically as far as you can go in terms of regulatory harmonization without supervisory integration. If you make the decision now to go for supervisory integration, you can finish the job of regulatory harmonization, but only then. So that's why the sequence, I think, makes sense the way I have tried to explain it. And with that, back to you.
Thank you so much. We will continue these conversations as the proposals come out, as the conversation continues. As always, our reports and our podcasts and our events and archives are free on our website, bruegel.org. If you need to revisit anything, you can get the PDF of Nicolas' book. Huge thanks to Stefan Ingves for your preparation and your willingness to come to Brussels, even if the skies did not line up for us today. To Nicolas Véron for the book, and to you all for coming. Thank you and have a good day.